The Alabama man who hacked the SEC's X account is facing a $50,000 fine as part of his plea deal. The hack caused prices to plummet and sparked fears that the SEC was going to approve spot Bitcoin ETFs. However, the agency later reclaimed control of its account and confirmed that the post was fake. SEC approved spot BTC ETF. The SEC paved the way for the first spot Bitcoin ETFs to begin trading Thursday. This was long awaited by the crypto market, as it brings more legitimacy to a space that has been hit by scandal and fraud. It also opens the door for risk-averse investors to gain exposure to Bitcoin without holding the underlying asset directly. These ETFs would operate on regulated financial exchanges, which means they must meet strict regulatory standards for transparency and investor protection. This could help to mitigate the risks of investing in a cryptocurrency like Bitcoin and build trust among institutional and retail investors. Investors will be able to buy and sell ETF shares on the same stock exchange as regular stocks. This removes the barriers to entry that come with buying and selling actual Bitcoin, which requires setting up a digital wallet and dealing with crypto exchanges. Additionally, the 11 spot Bitcoin ETFs that were approved will only trade when markets are open, unlike the underlying asset, which trades 24/7. ETFs charge fees, which cut into potential returns over time. However, these fees are typically low compared to the overall investment industry. Investors should always read the fee structure before making a commitment to an ETF. Some critics of the new spot Bitcoin ETFs point out that they could be used to fund other investments, which dilutes the value of the ETF itself. Others note that the new ETFs will bring more attention to the speculative nature of Bitcoin, which was created as an alternative to fiat currencies, those established by and backed by a government. Despite these criticisms, the new ETFs have opened the door for future innovations that could allow for even easier access to the crypto market. For example, a company called Galaxy recently filed for an ETF that tracks the second largest cryptocurrency, Ethereum. If it gains approval, this will make the world's most popular cryptocurrency much more accessible for the average investor. It might also pave the way for other innovative products that use blockchain technology. Crypto price drop. A 25-year-old man from Alabama has pleaded guilty to hacking the U.S. Securities and Exchange Commission's X, formerly Twitter, account and posting a false announcement of Bitcoin ETF approvals. The fake post, in the name of SEC Chairman Gary Gensler, caused Bitcoin prices to spike by about $1,000 per coin, according to the Department of Justice. The SEC later issued a retraction and acknowledged that the announcement was unauthorized. The SEC's X account had been compromised using a SIM swap, an attack that targets a victim's mobile phone number to gain access to their online accounts. Federal prosecutors say the perpetrator, identified as Eric Council Jr., helped his unnamed co-conspirators take over the account by stealing the victim's personal information from their hacked phone. They then used the stolen information to reset the account password, and to create a fake announcement about spot Bitcoin ETFs. X has long struggled with protecting high-profile users from SIM swapping attacks. The company's safety team has previously warned that such takeovers can be used to manipulate the price of cryptocurrencies and other assets. The company is now working to better protect its users from these kinds of social engineering attacks, and it has also started enabling two-factor authentication by default for all accounts. The breach of the SEC's X account was a serious embarrassment for the regulator, and the SEC's top cybersecurity official has received significant criticism from members of Congress, including Senator Ron Wyden, DOR. In a letter to the SEC, Wyden said that the incident was inexcusable, given the agency's recent efforts to raise the bar on enterprise cybersecurity standards. The SEC's X account was breached because the company had disabled multi-factor authentication on the account at its request in July 2023, and it hadn't re-enabled it after the breach occurred. It isn't clear why the company didn't enable MFA again after the breach, but it is possible that some of the underlying problems with SMS-based MFA was still present in the SEC's account. This is one of several reasons why companies should consider using a cloud-based MFA solution like Authy or RSA SecureID. SEC approved spot Ethereum ETF. The SEC's approval of spot Ethereum ETFs is a significant milestone for the cryptocurrency industry. The ETFs offer investors a more regulated and accessible way to invest in the digital asset. However, the move also highlights the challenges of regulating cryptocurrency investments. The ETFs will track the price of Ether, the second largest crypto behind Bitcoin. They will be traded on the CBOE and CME, and investors will be able to access them through their traditional brokerage accounts. This will eliminate the need for direct trading on exchanges or self-custody of cryptocurrencies. The ETFs will be subject to strict regulatory oversight, which is expected to provide investors with more peace of mind compared to direct investment in cryptocurrencies. Investors can expect the ETFs to have low operating expenses. Most of the issuers have planned to waive fees at launch, aiming to attract investor interest in the space. However, investors should note that the ETFs won't benefit from in-kind creations and redemptions. Instead, they will be required to buy and sell Ether for the purposes of creating and redeeming shares, which could reduce their performance. It's unclear whether the ETFs will be able to take advantage of staking rewards for Ether, which is an important driver of price growth in the cryptocurrency. Staking rewards are earned by the Ethereum blockchain network when its miners perform tasks on the platform. However, staking is only possible if the Ethereum blockchain has sufficient active nodes to verify transactions. In the past, critics of Ethereum have claimed that it should be classified as a security, arguing that it meets the Howey tests for criteria: an investment of money, an expectation of profits, a common enterprise, and reliance on the efforts of others. However, recent regulatory developments and the success of spot Bitcoin ETFs appear to be paving the way for ETH to be regulated as a commodity rather than a security. The approval of these ETFs may catalyze further institutional investment in Ethereum, boosting its market value. The ETF's approval is also likely to lead to further financial products that will further integrate cryptocurrencies into the mainstream financial system. SEC approves spot Litecoin ETF. In a move considered a watershed moment by many in the crypto industry, the U.S. Securities and Exchange Commission has approved the listing and trading of ETFs that track spot Bitcoin. The approvals are expected to open the door for broader investment in the world's most popular cryptocurrency by offering investors direct exposure to the coin without the risk of buying from unregulated exchanges or the higher costs associated with funds that invest in Bitcoin futures. The SEC has been wary of approving any Bitcoin ETFs in the past, with its chief, Gary Gensler, being a vocal critic of the sector. But in a statement supporting the decision, Gensler said that the approval of these ETPs cabinets the products to one non-security commodity, and does not indicate the Commission's view as to whether the market for this asset is regulated, or whether registered exchanges and other participants in the market have the necessary infrastructure to protect against fraud. The first pair of spot Bitcoin ETFs began trading on January 11, giving investors options right away. The funds are designed to mirror spot Bitcoin prices minus fees and trading costs, making them the most accurate way for retail investors to gain exposure to the world's most popular digital currency. Despite these advantages, the spot Bitcoin ETFs are not for everyone. Investors should carefully consider the risks involved, including the potential for price volatility and liquidity issues. Additionally, these ETFs are not suitable for short-term investing. For sponsors of existing private crypto fund structures, the approval of these ETPs will allow them to offer spot Bitcoin ETFs side by side with their registered ETFs that invest in the futures markets. This could result in greater interest in these products from institutional investors who currently are only able to access the cryptocurrency markets through futures-based investments. In the near term, it's likely that more spot ETFs will follow suit as more market players seek to capitalize on the rising interest in cryptocurrencies. In a market that is rapidly evolving, it's important to stay informed and understand how your investments work.